everyone, welcome to Bankable and NDTV Profit. It's a show where we discuss how the banking sector is evolving at this point in time, what the leaders in the banking sector are seeing as potential threats and potential opportunities going ahead, and how exactly they want to play it as an institution and as a banker themselves. To discuss these topics during this episode of Bankable, I have with me Mr. Rajiv, Anand, Deputy Managing Director at Axis Bank. Mr. Anand, welcome to this conversation.
Thank you for having me.
Bankable. Let's start with a broader economy question. The current environment is that globally things are pretty much either slowing down or very, very, very status quo, but then India is like this bright spot. Growth is going strong. Sure, there might be some areas which may not be looking exactly great, but broadly things are looking strong. As a banker, when you see the environment, what are you seeing as potential green shoots or potential opportunities that a bank of your size could exploit for itself?
I think when I look at the asset side of the balance sheet, we are seeing strong growth across all our segments. On the corporate side, domestic demand for loans continues to be strong. Both working capital, capex, and this is a question that you keep asking, is private capex happening? Certainly happening. I think it's a lot more measured than what we used to see earlier. Corporates are being a lot more cautious, looking at their cash flows and putting on new capacities. They're also using their own accruals rather than using leverage. And so therefore, there is a certain level of aversion to leverage at this point in time. Good from a India Inc. perspective, but not so good from a head of a corporate bank perspective. But it's not as if, just because they're not borrowing from us doesn't mean that we're not getting businesses from them. I mean, we will get CapEx, LC business, BG business, new salary businesses, etc. So the businesses will come to us. The SME business, to me, is a very, very exciting business. I think the kind of work that is happening within this space across the country, I think is tremendous. And I do believe that the MSME sector over the next decade will be what retail was in the previous decade. You're seeing more data around them. I think some of the tax arbitrages have gone away thanks to GST. So the balance sheets are looking a lot cleaner. More transactions are going through digitally. So where many of these entities were data dark, we know much more about them. Yes, it continues to be a collateralized business, but I do believe that this is a space that will continue to grow very strongly as we go forward. Yes, I think this is not a unique comment. We are certainly seeing a lot more competition, within this space as well. It is well diversified. And it is well diversified from a geography perspective as well as sectorally, and so therefore, to that extent, we do appreciate the fact that it is a higher risk business, but it is it pays for the risk is paid for, and it's a very profitable sector as far as we are concerned. And finally, of course, retail has been a great story over the last decade. Penetration of most products still continues to be relatively low, and I think to that extent we will continue to see retail growth going quite strongly as we go forward.
Okay, you've laid out the plan, made my job easier, honestly, because I would like to tackle each of these individually. Coming to the corporate story, because you mentioned capex first. So let me ask that. You said it's not what we are used to seeing, but there is definitely capex. People are actually, companies are investing, and some of it may not come from banks, it may be coming from internal accruals. But then how does that help a bank? I mean, isn't a bank supposed to ride that wave? And if people are depending on internal accruals, then it makes it difficult for you to grow, right?
So as long as growth continues, and I do believe that fundamentally this country can quite easily grow at about 6.5% over the next decade. Add another 5% of inflation, you're talking about 12 to 13% growth as we go forward. I think if growth of that nature continues, I think it is inevitable that stage one, which is of the use of internal accruals, will get used up. But at some point in the future, corporates will come to banks to be able to for them to be able to borrow money, from us. The way I see it, and remember that corporate India is very, very savvy. For us, the focus really is to ensure that we are serving them across the capital structure. If they want equity, we can help them. If they want global debt, we can help them. If they want local debt, we can. And we also use our own balance sheet. And so therefore, the focus is not necessarily on growth, but rather being able to serve the customer, and maybe some of the incomes will come on the NII line, and some of them will come on the fee line. And so therefore, I'm not too concerned about the fact that, hey, will the corporate books grow? I think corporate books will certainly grow as we go forward.
Okay. Over the last 8 odd years, as we've seen this recovery sort of take shape and now become more of a reality, there has been a clear reshuffle in that corporate list, in the list of promoters who are active in the space, who are credible names and names worth backing as a lender. The last cycle saw a lot of promoters coming in who probably did not have that much experience in project businesses, but then they ended up in that business, and then that led to a huge NPA cycle because lack of experience, lack of funding, lack of morality, all of that played out. How do you as a banker ensure that is not repeated?
Let's look at it from the corporate side first. We spoke about the fact that corporate India's balance sheet itself is in the best shape that we've seen in at least a decade. Debt equities are low, debt EBITDAs are very well managed. And so therefore, risk on corporate India's balance sheet itself is relatively low. Banks have tightened their underwriting standards, thanks to all the learnings that banks have had in the previous cycle. So, for example, Axis Bank, in general, we are focused on A- and better customers. Correct. Yes, we have a mid-corporate book which is largely BBB, but it's a very well-contained exposure. So banks have chosen to work with the better-rated corporates as well. So you're in a situation where underwriting standards have tightened, and corporates have eschewed leverage at this point in time. And so therefore, this is actually a pretty good situation, and it is highly unlikely that we will make the same mistakes that we made in the previous cycle. Maybe we'll make new mistakes, but we will certainly not make the same mistakes that we made in the previous cycle. Second is, I think availability of capital has also significantly improved. We are now seeing a lot more foreign capital coming in through many of the venture capital, private equity guys who are bringing in new pools of money. They are providing that to, for example, in the real estate space, they are providing that capital to promoters in the real estate space, for example, which was typically always been starved of capital. We are also seeing new instruments coming up. I mean, REITs, InvITs. While banks can't lend to REITs, but it now suddenly brings in new pools of capital, for corporate India. InvITs have inherent benefits of being a pool of assets, and therefore the ability of banks to lend to some of these entities is certainly exists. I think the important point is ultimately what you're doing is you are backing the promoter, and I think banks, Axis included, has a long list of promoters that we will no longer do business with, and so therefore the promoters that we are backing are promoters that we are quite comfortable working with. In many of these cases we've got a history of 5, 10, 15, 20 years. So they've proven themselves through the cycle, and I think I won't worry too much about credit risk emanating from the corporate side anytime soon, because of a couple of things that I mentioned on the corporate side as well as on the bank side.
Okay, I want to move away from the corporate bit and come to the SME bit, because you sound very excited by this. A classic theory on SME is high risk and not entirely sure where it's headed because limited people are in it. You've got public sector banks who do some business, private lenders out there in the market. I'm talking about the non-bank sector that does a lot of it, and then a bulk of it is done by the unstructured financiers. You said the data dark element is going away and reducing. Yes, so that helps you in better assess these as borrowers. How far away are we from a point where SMEs can fully rely on institutional funding?
There are about 7 crore MSMEs in this country. More than 90% are M, which is micros. I think, and I think the vulnerability of the micro segment, obviously because of the very nature of the businesses, the mortality in that sector is quite high, will continue to remain quite high. But the SME sectors, which is therefore maybe a million of them in this country at this point in time, most of them would have access to institutional funding. Most of them have been in business for a fairly long period of time, in many cases multi-generational businesses as well. Many of these entities are in fairly sophisticated parts of our economy. So there's a client of ours who's in aerospace, for example, specialty chemicals, export of toys and such like. And these are fairly sophisticated businesses, have gone through the rigor. They have very evolved buyers on the other side. The entire supply chain is fairly evolved, and they have the ability and ambition to grow as we go forward. One is not really too worried about this space. Once again, because of the fact that they are relatively small, the vulnerability to geopolitics or global supply chains, etc. These are certainly impacted, and therefore, as a risk mitigant, you will contain the amount of exposure you're taking on a per SME basis. You will diversify risk across sectors. You will diversify risk across geographies to be able to mitigate the fact that many of these are relatively small entities.
I've spoken about the opportunity bit. I want to start on the risk side of the story. You said over the last 12 to 18 months, liabilities have been a bit of a challenge. When this problem started at some point last year, when the rates started turning, and then everybody was like, okay, now liabilities pricing has to change, and people have to retain the deposit base that they have and continue to grow. Why has it taken 18 months, and why is it still a challenge? Is my question.
I think the pool of money, by definition, I mean, you are in a tighter liquidity condition. Remember that, through the cycle, through COVID, we've seen rates go up and down by, approximately 250 basis points. On a post-COVID basis, we've seen a situation where, RBI has hiked rates, RBI has hiked CRR, RBI has sold dollars, and so therefore that is the one piece. The only way that money goes out or into the system is through those RBI mechanisms, right? And RBI by definition has chosen to keep liquidity tight at this point in time, and therefore you've seen that that 1 year deposit rates have gone to somewhere between 7.5% to 8%, depending upon which bank you're talking to, and therefore relative to the 3.5% that you're seeing on savings account, you're able to get 7.5% on a 1 year deposit. And so therefore what I call the cost of laziness is now is 400 basis points. Remember that the savings account is a transaction account. I mean, this is what I pay my SIPs through, my EMIs through, my bills through, etc. Under normal circumstances, I will, sort of let the money lie there. But if I now find that I have slightly more money, let's say, usually I have 1 lakh in the account, but now I have 2 lakhs for, because I've got a bonus or, I've saved some money. Under normal circumstances, you let it remain. But where I can move, where I can get 7.5%, that extra 1 lakh I will now put into term deposits, which is really what is happening. But remember that interest rates are cyclical. It's not as if we've not seen this movie play out before as well. And I think we're already beginning to see the first signs of central banks talking about cutting rates. And I think that cycle will come to India perhaps over the next 6 to 12 months. And then this will start to adjust itself. And I think this is, if you look at India over a 20-year period, we've never had a situation where deposits has been a concern. I mean, there's always been lead lags, etc. But deposit growth has traditionally been, fairly strong for it to support asset growth, and I do believe that this will adjust itself over the next 6 to 12 months.
Okay, fair enough. The other risk part, which is regulatory tightening. We've seen monetary tightening start May last year and then still continue. But regulatory tightening over the last 2 months, you've had action on unsecured loans, and you've had action recently on the alternative investment fund situation. Is the regulator tightening screws for a better system, or are they seeing something which is probably worrying them and they see a need for this?
First and foremost, if you look at on the unsecured side, the increase in risk weights is actually just a normalization. Through COVID, they cut the risk weights. Yeah. It used to be 125. They've just brought it back at this point in time. So therefore, it is a normalization at one level, and I think it also shows confidence of the RBI in the underlying economic situation that the economy will quite comfortably be able to absorb the higher risk weights at this point in time, because the point I'm making there is, as soon as you start to increase risk weights, it is inevitable that cost of money to adjust for that, the capital charge will automatically start to go up, and I think to that extent, RBI is quite comfortable. I think RBI is concerned about certain pockets of perhaps risk playing out, and so therefore, on the unsecured side, within that, there's sort of lower ticket loans. Is something that that they are certainly concerned about, and countercyclical measures like this is always welcome. Similarly, and I think you spoke about the AIF issue as well, and I think it's they are trying to contain the whole sort of evergreening issue that perhaps they have seen in few cases, and therefore trying to address don't want to leave the door open for such practices. And I think I like the proactivity that RBI has shown on each of these measures to be able to nip some of these issues at the bud before they become potentially systemic. I mean, you can always argue that, hey, why did RBI act so soon? Is the problem that big that they need to come in so quickly? But I think it is better for them to nip many of these things at the bud rather than become systemic issues, and perhaps then some of the measures that they would need to bring could have even more impact and have potentially destabilizing impact either for the markets or for the economy.
Okay. Last question from my side is a risk that has sort of become a little more of a talking point in recent years, which is your younger workforce within the banking system is happily jumping jobs. They are not really concerned about what traditionally workers used to be concerned about. Oh, my CV is going to look bad if I jump 3 jobs in 2 years. They don't care about that anymore. The certain expectation of the workforce from its employer has also evolved over time. They don't just want a stable job and a salary. They want more. They want benefits. They want less pressure. Is the financial ecosystem ready to embrace those changes?
I don't think the financial system has a choice. I think it is super important that employers listen to the expectations and aspirations of the workforce. I'm not saying that every employer will be able to meet all expectations of the workforce, but I think it's very, very important that we are doing that. The good news, Vishy, is also that I think attrition used to be a big issue last year. But I think as I look at the numbers for the banking system in the first half of the year, we've seen a significant drop in attrition. So therefore, that's good news for the banking system. We have to listen to our employees. They want to work post-pandemic on a more flexible, in a more flexible environment. So, if you say that you have to come to office, 5 days a week, you are going to see attrition, and therefore you've got to create this environment where you can do a hybrid, which is what we, for example, Axis Bank has moved to a permanent hybrid model. There is a whole bunch of people who want to work on projects, and so therefore we have something called gig employees. And I think the beauty of gig is also the fact that we are able to access pools of people which hitherto may not be accessible to us, and so therefore they are working 100% remote. And they are adding value to the organization. Maybe they'll work for 3 months, maybe work for 6 months, maybe 1 year. But it serves the purpose for the employee, it serves the purpose for the employer. In many of these cases, I don't have to manage his or her career, but this specific person is doing a specific job, within the organization. I think compensation, etc., is table stakes. I mean, I think the fact that your compensation has to be competitive, I think is a given. But I think the workforce also needs to understand that ultimately we have responsibilities to various stakeholders, to our shareholders, to our board, to the regulator. And I think we have to meet those expectations, which means that we have to build a long-term, profitable, sustainable business. Which means that we have 4 crore customers on the retail side, and we bank pretty much everybody on corporate India. And I think our customers have an expectation from Axis Bank as well. And so therefore, if you have chosen to be in the service sector, and if you've chosen to work with Axis Bank, there is a certain expectation that you will have to meet. Otherwise, don't join this or any other organization, right? And so therefore, ultimately, it comes down to the fact that having appropriate platforms to listen to your employees and to be able to fine-tune the workplace, that it is not just rewarding, but it is also a fun place to work, and hopefully that you can build a long-term career with any particular organization is I think one of the key requirements as you think about any management team in corporate India.
All right. Thank you so much, Mr. Anand, for joining us on this conversation.
Thank you so much, Rishi. Thank you for having me again. Thank you.